Hello investors and welcome to my YouTube channel where I study the best investors and businesses from around the world. Although Mohnish Pabrai is most known for his cloning strategy, did you know that he also has two other investing strategies he uses to his advantage? But this week, I'll be covering Pabrai's cloner's investing strategy. What if I told you that one of the best investors in the world just released a type of portfolio that not only beats the market, but beat the S&P 500 by a staggering 10.7% during one of the worst 16-year periods in market history? And I'm not talking about the total return amount either. It beats the market by 10.7% every year on average. In this video, I'll tell you exactly how he does that. It's called a 13F, and it works like this. Any investor with $100 million or more invested in the U.S. equity markets must disclose everything that they have bought or sold within 45 days of the quarter end. They must do this. It's the law, and it's to our great benefit, because this information is public. Yep, we as the average investor have the opportunity to see what the best investors in the world have recently bought and sold, all for free. Every February 14th, May 15th, August 14th, and November 14th, we get to read the 13F filings from value investors. This 13F is a quarterly disclosure required of all individuals and entities who have 100 million or more invested in the U.S. equity markets. These filings are publicly available at no charge to anyone. Websites like Datarama or the Ticker Terminal make it a breeze to track the picks of various value investors. So why not just copy the exact trades that these high-value investors make? Well, not so fast. Let's see if we can convince ourselves that cloning is really the best way to get high returns from our money. Let's ask ourselves three critical questions. Number one, the first and most important question to ask is, does cloning a high-value investor's portfolio really give us better returns than the market? A 2008 research study by Professors Gerald Martin and John Puthenparakel, entitled "Imitation is the Sincerest Form of Flattery," cloned Berkshire Hathaway's equity portfolio between 1976 and 2006 by investing in the positions with a substantial delay. Their clone portfolio always bought or sold the last trading day of the month when it was publicly disclosed that Buffett had bought a new stock or sold off an existing one. In their paper, they say that over the period, the portfolio beat the benchmarks in 27 out of 31 years, on average exceeding the S&P 500 index by 11.14%. The value-weighted index of all stocks by 10.92%, and the FAMA and French characteristics-based portfolio by 8.56% per year. Meb Faber, who wrote the book Invest with the House, also conducted a similar study that showed an outperformance of Berkshire Hathaway from 2000 to 2014 of 10.53% versus 4.31% for the S&P 500 during the same period. So it seems like cloning might be a good option to try. But this raises the second most pressing question: which value investor should we clone? While cloning Berkshire's stock portfolio has proven to be a winning strategy with Berkshire's mammoth size today, a similar strategy employed in the coming decades will likely not do as well as the last few decades. With the market cap exceeding $400 billion, Berkshire needs to make very large bets to move the needle. This is in sharp contrast to its sub-$100 million market capitalization in the 1970s. In fact, Buffett himself has said that he cannot make trades the way he used to due to the fact that the amount of funds that he has does not make the needle move in his returns. The good news is that there are at least a handful of value managers who manage a small fraction of what Buffett does. According to Pabrai, here's a list of 9 such value managers who fit the bill. Number 1, Appaloosa Management, an American hedge fund founded in 1993 by David Tepper and Jack Walton, specializing in distressed debt. Number 2, Cedar Rock Capital, an investment firm that pursues a long-only buy-and-hold global equity strategy. Number 3, FPA, First Pacific Advisors, a money management firm practicing a disciplined approach to value investing, prudently seeking superior long-term returns while maintaining a focus on capital preservation. Number 4, Greenlight Capital. A hedge fund founded in 1996 by David Einhorn, Greenlight invests primarily in publicly traded North American corporate debt offerings and equities. Greenlight is most notable for its short selling of Lehman stock prior to Lehman Brothers' collapse in 2008. Number 5, Markel Insurance, which is a holding company for insurance, reinsurance, and investment operations around the world. Number 6, Pabrai Investment Funds. Mohnish Pabrai is the founder and managing partner of the Pabrai Investment Funds, the founder and CEO of Diendo Funds. Although he works alone, he does have a few quants and interns that help him from time to time. Pabrai deserves credit to popularizing this cloning method of investing and is the author of the Forbes article this video was inspired by. Number 7, Sequoia Fund. An American venture capital firm, the firm mainly focuses on the technology industry. Number 8, TCI Fund Management, a London-based hedge fund management firm founded by Chris Hone in 2003, which makes long-term investments in companies globally. Number 9, ValueAct Capital. ValueAct makes a significant investment into the company and then works with the company to make changes with the goal of increasing long-term stock value and thus creating a profit for ValueAct. If you randomly chose just 5 random investments from one of these value managers, how would this 5-stock portfolio perform over the last 17 plus years? This is exactly what Pabrai and his quant Fei Li decided to do. Well, the shameless portfolio did astronomically well compared to the market average. The shameless portfolio beat the S&P 500 by 10.7% annualized. If you want to know the exact stocks that Pabrai and Fei picked for the span of 17 years, I suggest you read the Forbes article, which I will link to below. Pabrai's thesis is summarized by his quote, "When you only basically buy ideas that other great investors have already bought and studying them, the error rate you will have will be a small fraction of what you would have if you went out on the prairie on your own. If you go out on your own and you look at 10,000 stocks and pick 10, trust me, your error rate will be off the charts. But if you pick 10 out of the 40 that great investors have bought and you looked into why they bought them, it's like bowling with bumpers. Never bowl without bumpers when they offer you bowling with bumpers." Mohnish Pabrai in his 2012 lecture. Pabrai and his team will publish the updated list of the 5 cloned ideas for the year on his blog chaywithpabrai.com. It's interesting to see that over a long period of time, shameless cloning averaged out 16% compared to the S&P that resulted in 5%. Which goes to show that cloning the best investors and their investments might be one of the most opportune and easiest ways to make great returns. In fact, I'd say to be highly successful in any field, you don't have to be a genius, nor do you have to be enormously talented, or even put in the legendary 10,000 hours of practice. Instead, you need a repeatable system that works, and the best system of all is to identify great examples in your field, work backwards to figure out how they were created, and then make your own version, which puts your unique spin on that proven formula. Build on what's already working and add in your own flair. The book Decoding Greatness, How the Best in the World Reverse Engineer Success by Ron Friedman, does a great job of showing that this is true across several disciplines. While reverse engineering may appear to have limited applications outside of the computing world, its applications are surprisingly broad, actionable, and compelling. In fact, reverse engineering is a popular tool among literary giants, award-winning chefs, comedy legends, Hall of Fame musicians, and championship sports teams. More importantly, it's one that you can use in the field to learn from your friends, extract useful ideas, and evolve your work in new and exciting directions. If you're still not convinced, let's look to the oracle himself, Warren Buffett. Buffett admits that much of his early success was the result of coattailing. He followed the activities of top fund managers like Graham, whose ideas could make him a lot of money. When we start in anything, it's natural to find gurus or mentors to follow. It is comforting to see that investors of such stature as Warren Buffett used coattailing to form his early investing structure. Number 3, the third question to ask ourselves is, what are the risks of shameless cloning? I have to mention there are the 3 risks that shameless cloner must take into consideration before adopting the strategy. Risk number 1, stay in your circle of competence. Even if we see value investors investing in the business, we should stay within our circle of competence. By staying within our circle of competence, we avoid investing in companies that we just don't understand. Risk number 2, clone only value investors. The best fund managers to shamelessly clone are typically value investors because of their propensity to hold their investments for longer periods. Buy and hold investors are better to follow because the time lag between an actual trade and its reporting may be a detriment to effective trade replication. Some managers, such as Carl Icahn or Michael Burry, who uses quite a lot of different strategies to invest, such as hedging, shorting, and leverage, among others, lead to difficulty in tracking his portfolio. It's much better to follow someone like Buffett, who likes to say his favorite holding period is forever. Risk number 3, success is not guaranteed, but risk is minimized. We have to keep in mind that success is not guaranteed. No investment strategy is a surefire winner. For example, a corner may have to stick with the strategy for many years because if you are following a value-based investor, it can take many years for the stocks to blossom. In this case, losing patience and abandoning the strategy early may result in substantial losses. There might also be some losses since the stock may have already moved significantly between the time it was acquired and the time it was announced. This harms the stock's risk-reward profile for the cloner. With these in mind, I'd love to know who your favorite investor is and why in the comments below. Thank you so much for watching, and if you got anything of value out of this video, smash the like button since that'll help grow this channel. Leave your comments in the section below and let me know your thoughts about this video and what I should cover next.